All right, ladies and gentlemen, I hope you had a wonderful day. It was one for the history books in terms of what happened with the default. But as far as the market reaction, my goodness, was this mild. The S&P finally had its first 1% down day. It broke the 47-day streak without doing that. But why I'm saying this is mild, even though the NASDAQ dropped 2% today, the last time there was a credit downgrade, the stock market dropped 6% in one day. So everybody's kind of excited about this, but something bigger happened. And that's what I'm going to talk about on this video today. We're going to talk for the first half, and then I'm going to get into the plays. We don't really need the charts. I hope you're watching the bonds and the videos we've posted over the last couple of days. You should be able to follow along with the main theme. Tomorrow, we shouldn't be getting any crazy data. There is some PMI stuff, but I think Friday's the real big mover. The real thing we're looking for tomorrow is going to be Apple earnings as well as Amazon. But now, as far as what I expect from everything going on, the default as well as what just happened, there was something huge today. That's what we're going to go over. So let me start with the first part. I'm sorry, I'm going to have to tease you a little bit, so I hope you like the video by now, and I hope you know we're subscribed, or we're live, youtube.com/the stock market, okay. But all of this stuff is important, and just, I know a lot of people are wondering, all right, is this credit downgrade going to be a big deal? Everybody was debating it. You have a lot of people, and I was saying there's like two extreme sides of this debate. There's one side that's saying this is going to be extremely bearish because now with United States credit downgraded, all of these funds that are mandated to buy only AAA rated bonds or certain quality of bonds, they will be forced to sell off, and that mandatory selling will cause a bunch of momentum and bearish issues. That is the extreme side because a lot of people bring doubt to that. I even doubt that a little bit. On the other side of like extreme positive, there's people saying, well, this downgrade means nothing, even though it will affect the permanent record of the United States. Yes, you could get a credit upgrade. However, the last downgrade never got upgraded. And if credit agencies are upgrading and downgrading at that one point, you got to ask yourself about how credible that is. But people are saying this means nothing. It's a vanity rating, and that's why we barely moved, and it shouldn't really affect much. America's doing the best out of literally everybody in the world. We have the best liquidity. We got everything under control. It's strong. It's resilient. Call it what you want. We're the best. So people are still going to buy treasuries no matter what in bonds. This smaller rating downgrade, if it doesn't stop people on junk, this sure would not stop you on the most liquid asset-backed asset in the world. You know, it's the bonds, bro. So that's the two sides of it. I don't know where we're at, man. I think we're somewhere in the middle, and it's going to take time. I was talking about it today. The way I'm looking about how this will affect the market, it reminds me a lot about the banking crisis. Something big happened. It's like when the banking stuff was developing with SVB. You're hearing about officials. These are the first rumblings and reactions, but this is a big deal. It does not occur often. It's leaving a mark, a permanent mark on the credit agency or the credit rating of the United States. However, as bad as it may be, what we learned from the banking situation, you open up a liquidity facility, you say the right words over and over and over again. If the perception's there, you provide the backing. It doesn't matter how big the crisis was. If you could kind of calm people down and provide the right liquidity, aka the Fed, I mean, I hate to say it. Do I like that? No, but that's what we saw. So I'm not going to say this is going to be the death blow when we've already witnessed a lot this year. Now, maybe it could be the straw that breaks the camel's back, but we got a lot of other events lining up here, but that's the way I'm looking at it. It reminds me early stages of the banking stuff. I don't think you got to sell your long-term. You know what to do with bill and higher interest rates, diversification. You know, my midterm, my long-term strategy does not change one bit off of this. However, I do think we got to work through the events and let this play out. So I think right now it reminds me early day of banking crisis, and we'll see as this develops, and we will get more answers on the real effect and see as everybody in the narratives balance between those two extremes. So that's the take on what happened today. Now let's talk about what really happened. This is the crazy part, because there was a big announcement, and it's part of why we've been watching the bonds just get destroyed over the last couple days. Before the downgrade, we saw a bigger move on bonds yesterday and earlier in the week than we saw on this downgrade move, and there was talks about refunding. That was earlier in the week, and there was a lot of other things playing into it, but today, the big thing we heard about was the refunding and how much more they are looking to ask for in all of the future bond auctions. Who is they? It is the Treasury. Now, I'm going to explain why this is such a big deal, because this is the silent rate hike, or this is maybe where we could actually see quantitative tightening take effect. But I don't know if you remember early days of 2022, maybe other times in the market, if you're familiar with quantitative tightening, taper tantrums, all of that, everybody would talk about quantitative tightening. The Fed was going to not buy as much. They're not going to do this rollover. They are going to slowly stop buying the bonds. People were worried. It was talked about acting on the market as a rate hike. Even Jerome Powell has said that himself. So why it never really hit the markets, there was a lot of things that happened in bonds, but people really just assumed it wouldn't have an effect. They told us about it so early and in advance that the market was prepared for it, but the final piece of the jigsaw was simply at the same time the Fed said we are going to be buying less bonds, which is a form of quantitative easing to a degree. The Treasury also was announcing that they would be offering less amount of debt for sale. So in a weird way, it kind of negated each other. Even though they were doing quantitative tightening, the net effect, there wasn't really anything too crazy going on. So that's why the announcement today that they are going to be raising these amounts when previously everybody thought they were lower. And if the Fed is sticking to the same pace of QT, I don't think they've increased it recently. But now if they start raising more debt, now you have the QT, you get that little invisible pseudo rate hike that's been discussed. So is it going to hit immediately? No, but this is just one of those factors, and that is a big part of the reason that people are talking today. But I would implore you to just ignore the stock market. I know it's weird for the guy who runs youtube.com/the stock market or the trading fraternity, but take a look at the bonds. This action over the last couple of days, bonds have been more crazy than stocks. And depending on even how this downgrade plays and how people feel, if it causes tightening, we'll see after the earnings and non-farms by Friday. But that could also impact the bonds. And now, even jumping back to the downgrade and what happened, this was another part of everything we talked about today. I'm kind of jumping back to the first subject, but understand how 2011 actually played out. We brought this up during the debt ceiling stuff. So that's the irony of all of this, is that people were asking, if this happened during the debt ceiling, do you think that the default would have had a bigger effect? It might have, but at the end of the day, this is exactly what happened in 2011. So go through the Wikipedias, go through everything, but it was right after the government came to an agreement on the debt ceiling in 2011. They got the downgrade. It was a couple days or a couple weeks after that things started to go down, and they got the downgrade from the S&P. So given how we were during the debt ceiling, I think there was more volatility. Literally, like US CDSs were at a way higher price. So it would have probably had a bigger effect, but when we were even talking about it, we were always comparing this to 2011, and even 2011, the downgrade came after. But now, this is what we talked about today, because if you look at what happened in 2011, the market was already going down before the downgrade hit. So on the day of the downgrade, we dropped 6.5%, and a lot of people will tell you by the end of the week or so, or I think the month, you were back to break even. 5 days later, I believe you recovered, but this is the recovery pretty much after the downgrade and the debt ceiling debacle. It led you into this like 3-month zone up until the end of the new year. So if you keep zooming out, this chart doesn't show it. The markets went up 254% or something. Again, this was 2011. So obviously you're here today. Look at the market, look at the prices, but just understanding how 2011 played out, that's why everybody is looking at the downgrade today. It happened in a similar fashion. Now we're watching the reaction, but it is a little bit different to to what we experienced. And now we have these events, and we're going to see where the rest of the world takes all of this, because now we got to see the response from everybody else. So, Chad, it's going to be wild. Welcome to the August seasonality in September, but I hope you are ready for a lot more. I think we're living through it now, and these next couple of days, weeks, and months, the first day, the first week, the first month, 6 months, 1 year after event, that's what people are going to be looking at in the history books, and that's where I'm saying moving forward, that's where we got to go and move and see what happens. So I hope you're ready, but now let us get into the plays. So now that we got that out of the way, I did make plays today, and believe it or not, I made some weird plays. I made a hype squeeze play. I bought Rite Aid 30% up, and a lot of people were confused, so I ended up with 2,000 shares on the day. We were up on it a little, then I made another average down on it. I think my average is literally 224, 225 right now, but I think this could have a squeeze. People brought it up related to Tupperware, and we were watching this go up. Again, in the middle of a default, the market's finally having their first day. These random plays that are awful just run up. So, why did I buy it? It was the question everybody was asking, why does this happen? Yeah, it could be a short squeeze, but tell me if you've seen this over the years. This happens a lot. Sometimes on the days of volatility or things like everything going bad or selling off, small caps are kind of known to be their own little pocket where you could kind of go to La La Land and ignore it, and they often get attention and attraction during times like that. So in a weird way, it's a hedge. I mean, don't bank on it. This ain't a hedge. Don't tell the bank you got a hedge by buying right. They gonna laugh at you, dog, okay? So I'm just saying it has a huge element of risk. I think we bought it 30% up. You could lose a lot, but compared to the other squeezes, we're not breaking out like Tupperware. We called it out very early, but I said the $3 squeeze point, but it's it was already breaking out from previous highs into all of that. So I thought Rite Aid was good. I think it was its biggest day since 2021 or 2022. So we'll see how it plays out, but I think it'll get some momentum, or at least interesting to watch over the next couple of days. But I did that. I tried it on big too. That one messed up. They got earnings in a little bit, so this could be a hype play. I wound up with 1,000 shares. I'm not feeling this one the same. Looking to get a quicker exit. I was supposed to exit quicker, but I thought they had earnings tomorrow and they don't, so I think I could give it a little more time, but that's on the higher risk, and then kind of bunk for the hype play. We'll see, but it has cut their dividend last time. They had some good things going, or they've got rid of the bad, so we'll see, or at least it's easier to beat the lower bad. But those are the plays I made, and then I grabbed Etsy bond auctions, but I grabbed two. I like the leap, the 175s. This was right in the middle of the criteria, so I did make an earnings play. Etsy beat, and that was actually the theme of today. If you didn't see it, DoorDash, Etsy, Shopify, they had decent earnings. A lot of these companies, kind of like AMD, they beat on these metrics, but there wasn't blowout numbers. Some missed very slightly on other ends, but it wasn't these were awful misses, and a lot of them had some pretty sizable drops, even though the earnings weren't as bad as even 2 quarters ago. So pretty shocking to see in some instance, but that's what happened. But we were looking for the upside play, but I saw these leaps, and I was just talking. This play, it met that criteria just right at the cusp of it. So I said, it's if you're not on a winning streak, if you don't have momentum, I really wouldn't take this play. I think it's more risky, but it did borderline me. And what I mean by that is just take a look. These are one of the leaps. The option chain went really deep. Etsy is $300 before. The stock had kind of moved lately. Hasn't really moved much, but at the beginning of the year, they were at 150. So I grabbed a 175, but they were near that price at one point just a couple months ago. But looking at the premium, it was trading for 60, 70 cents not too long ago. I got in around 86 cents. I bought 10 of them, so I spent $800, a decent amount. But hopefully you see my dilemma, 60 to 80. It's up. It's cheaper than where it's at. It's not it has crazy premium. The yearly was right there. Again, it's not even a yearly anymore. Honestly, I was saying a leap, but it's a 6-month contract. But now if you go to the August, 2 weeks out, this stock was pricing in, I think it was $16 at the time it moved, or it was 11. But if you double that up, it's around $22. It was trading near 90 or so. But I went 2 standard deviations, or again, the rough 2 standard deviations, call it whatever you would like. But I guess, yeah, I think they were around 97. but I looked at the 120 contracts and they were going for like 60, 70 cents. I grabbed one of those that was like right there at the criteria. That's decently cheap for 2 standard deviations. So if they did have an earnings surprise, I figured that would have a great move. And just take a look, didn't have premium, so I felt much better buying this here than not. But then again, you see what happened with that earnings. So those were the plays as far as what I'm going to be looking tomorrow. I am going to be looking for some SPY shorts. I did want to wait a little for my re-entry on the NASDAQ, but I'm waiting for answers. I think it will determine after Amazon and then Apple, and then those are going to be the only other plays. If you don't remember, these Amazon puts, the pre-run-up play, still got these ones, so I plan to close these before the bell tomorrow. Maybe I'll hold 1 or 2 like the metas, but we were up like 100%. They came down after the other good earnings, and now they're like right up. I think I'm down like $20 on them. And then same thing, the Airbnb contract, we got out of the calls, so we got to take profits on those. But this thing came back. I think I'm down like $10 on it. I am going to be holding this one for earnings just in case, because I do have other options to the upside. So I like a little bit of Airbnb volatility, but I was saying this. Everybody's been asking me Airbnb, and I think the same thing might apply for Apple. I do believe Amazon might be able to move a little bit more, but like stocks like Airbnb and even watching the earnings now, it's like in a weird way, I feel like Airbnb already had its earnings from 125 to like 155, that $30 move. That's like 30% almost, and I'm happy with it, but even though I got rid of some of those calls and I still got some plays, I'm really not expecting a crazy move. And I think the earnings move happened with a lot of names, and maybe they hold up, and maybe we start responding to some of the broader stuff unless they do have blowout quarters, and that's what we need to get it moving. So we'll see what happens, but Chad, stay in the game, be ready. Things might start picking up here in summer, but either way, the long-term in Chad has your back, so I hope you're ready, but that is your watch list, ladies and gentlemen. Make sure hydrate, healthy, ready to go. Make sure you post your watch list. Make sure we see you there in the morning. I need the armor on. I need the helmet shining. And I need you to remember, I don't know if you got it today, but if before you start doubting, I don't know if you doubt, but if you do doubt, this is a great litmus test. How did you get there? The point of where you're doubting, what led you to that moment? Be honest with yourself, and then you'll know what type of move you're making, good or bad, baby. Oh my goodness, but Chad, get ready. I love you all. I will see you in the morning. It's the middle of the week. Let's close it out. Friday, Junior Friday. Then we get the more data. We still got non-farms. And then that's it. So I'm out. I love you. God bless you. Usa, you have the water. You already know. Drink it. That's it. I didn't Sam Obasanya, the Adidas, man. Too many post this. That's it. I'm too lazy to be an activist, man. That's it. That's why you buying stocks and stuff that you ain't an activist. I'm sorry, Billiam. Yeah, but well, I'm not. But no, but like they used to call them corporate raiders. I see. Instead of awkward, I just gave you a little lesson criticism on the natures of the markets. It's like, okay, I'm gonna go, baby.